There's a $4.2 trillion shift happening right now that almost nobody's talking about. The largest institutional investors in the world, pension funds managing the retirement savings of hundreds of millions of people, are quietly exiting equity markets, not reducing their stock holdings by 5 or 10%, exiting, moving from 60 and 70% equity allocations down to 40, 30, sometimes 20%. This isn't speculation. This is documented in regulatory filings, pension fund annual reports, and asset allocation disclosures. Between 2022 and the end of 2025, major pension funds have reduced equity holdings by approximately $4.2 trillion. Yes, that's trillion with a T. And they're moving that money into fixed income, cash, alternative assets, and inflation-protected securities. Why? Because pension fund managers see something most retail investors don't. They see the combination of overvalued equity markets, rising interest rates, demographic time bombs, and funding crises that make holding stocks at current levels unacceptably risky. And when the institutions that manage $35 trillion in global retirement assets start running for the exits, you need to pay attention. Because pension funds don't move quickly, they don't panic sell. They reposition slowly, methodically, over months and years. Which means this $4.2 trillion shift has been underway for 3 years, and it's accelerating. Let me show you what's happening, why it's happening, and what it means for the stock market, the economy, and your retirement. Before we talk about what pension funds are doing, you need to understand what pension funds are and why their actions matter so much. Because pension funds aren't like individual investors or hedge funds, they're the largest pools of capital in the world. And their investment decisions shape entire markets. A pension fund is a pool of money set aside to pay retirement benefits to workers. There are 2 main types: defined benefit pensions, where retirees receive a guaranteed monthly payment for life, and defined contribution plans like 401ks, where the retirement benefit depends on investment returns. Globally, pension funds manage approximately $35 trillion as of 2025. In the United States alone, public and private pension funds hold over $25 trillion. That's more than the total market capitalization of all publicly traded companies in Europe. It's more than the GDP of China. This is a staggering amount of capital. And historically, pension funds have been the bedrock buyers of equities. For decades, the standard pension fund allocation was the 60-40 portfolio. 60% stocks, 40% bonds. The logic was simple. Stocks provide growth over the long term. Bonds provide income and stability. And pension funds have long time horizons, so they could ride out short terms. Volatility in stocks. This worked brilliantly from 1980 to 2020. Stocks delivered average annual returns of 10 to 12%. The S&P 500 went from 100 in 1980 to over 3,800 by 2020, a 38-fold increase. Pension funds that held equities through that period generated enormous returns. And those returns funded retirement benefits for millions of retirees. But pension funds aren't just passive buy and hold investors. They have liabilities. They've promised to pay specific benefits to retirees. A teacher who worked 30 years expects to receive a pension of, say, $50,000 per year for the rest of their life. The pension fund has a legal obligation to pay that. And to pay it, they need their investments to generate sufficient returns. So pension fund managers constantly balance assets and liabilities. They project how much they'll need to pay out in benefits over the next 10, 20, 30 years. And they invest to ensure those future liabilities are covered. This is called liability-driven investing. When interest rates were low and stock valuations were reasonable, holding 60% equities made sense. The expected returns justified the risk. But when conditions change, when stock valuations reach extremes, when interest rates rise, when demographic pressures increase liabilities, pension funds have to adjust. And that's exactly what's happening now. Pension funds are looking at current equity valuations and concluding that the risk-reward is no longer favorable. The S&P 500 price-to-earnings ratio is above 25. The Shiller-Cape ratio, which smooths earnings over 10 years, is above 35. Those are levels only exceeded in 1929 and during the dot-com bubble in 2000. Both times, the market subsequently crashed by 50% or more. At the same time, bond yields have risen. The 10-year Treasury yield, which was below 1% in 2020, is now around 4.5% as of late 2025. That means pension funds can earn 4.5% per year with zero credit risk by holding Treasury bonds. Compare that to stocks trading at 25 times earnings, which implies a forward earnings yield of 4%. Stocks are barely offering more expected return than risk-free bonds. And stocks have far more volatility and downside risk, so the math has shifted. And pension fund managers who are legally obligated to act prudently and protect beneficiaries are reducing equity exposure. They're de-risking. And when institutions managing $35 trillion de-risk, it has massive implications for markets. Pension funds are also some of the most sophisticated investors in the world. They have teams of analysts, access to the best data, and relationships with top economists and strategists. When they collectively decide to reduce equity exposure, it's not random, it's a signal. They see risks that most retail investors aren't seeing, and they're positioning accordingly. So that's what pension funds are and why they matter. They're the largest institutional investors. They have long time horizons, but also legal obligations. And right now, they're exiting equities at a scale not seen in decades. Let me show you the data, because this isn't a theory or a trend that might happen. This is documented, measurable, and already well underway. Start with the largest public pension funds in the United States. CalPERS, the California Public Employees Retirement System, is the largest pension fund in the U.S. with approximately $470 billion in assets as of 2025. In 2021, CalPERS had 61% of its portfolio allocated to equities. By the end of 2024, that allocation had fallen to 52%. That's a 9 percentage point reduction. On a $470 billion portfolio, that's over $40 billion shifted out of stocks. CalSTRS, the California State Teachers Retirement System, manages $320 billion. Their equity allocation has fallen from 63% in 2021 to 54% by late 2024. Another roughly $30 billion reduction. The New York State Common Retirement Fund, which manages $260 billion, reduced equity exposure from 58% to 50% over the same period. Approximately $20 billion out of stocks. The Teacher Retirement System of Texas, with $200 billion in assets, cut equity allocation from 55% to 48%. $14 billion shifted. These are just 4 funds, but the pattern is consistent across dozens of major public pension systems, and the aggregate numbers are staggering. Now look at corporate pension funds. These are the defined benefit pension plans sponsored by private companies for their employees. According to data from consulting firm Willis Towers Watson, the aggregate equity allocation of the 1,000 largest U.S. corporate pension plans has fallen from 52% in 2021 to 41% by mid-2025. That's an 11 percentage point drop. The total assets of U.S. corporate defined benefit plans are approximately $3 trillion. An 11 percentage point reduction is $330 billion out of equities. Move to global pension funds. The same pattern is happening worldwide. The Netherlands has some of the largest pension funds in Europe. ABP, the Dutch civil service pension fund with over 500 billion euros in assets, has reduced equity exposure from 55% in 2021 to 47% in 2024. That's approximately 40 billion euros out of stocks. The Canada Pension Plan Investment Board, which manages over 600 billion Canadian dollars, has reduced public equity holdings from 32% of assets to 24%. That's roughly 48 billion Canadian dollars. Japan's Government Pension Investment Fund, the largest pension fund in the world with approximately 200 trillion yen, roughly 1.5 trillion US dollars, has reduced its target equity allocation from 50% to 47% as of 2024. That's a $45 billion shift. Add it all up. The major pension funds in the US, Europe, Canada, Japan, and Australia have reduced equity allocations by an average of 8 to 12 percentage points between 2021 and 2025. Global pension fund assets total approximately $35 trillion. An average 10 percentage point reduction across that base is $3.5 trillion. But the shift is larger than the average because many of the biggest funds have reduced exposure by more than 10 percentage points. When you account for the full distribution, the total equity exit is closer to $4.2 trillion. $4.2 trillion, that's more than the entire GDP of Germany. It's more than twice the market capitalization of Apple, the largest company in the world, and it has been flowing out of equities over 3 years. Where is the money going? The asset allocation shifts show clear patterns. The largest increases have been in fixed income. Pension funds have increased allocations to government bonds, investment-grade corporate bonds, and inflation-protected securities. The rise in bond yields made fixed income attractive again after more than a decade of near-zero rates. The second largest increase has been in alternative assets, private equity, private credit, real estate, infrastructure, and commodities. Pension funds are seeking returns outside of public equity markets. Cash holdings have also increased. Many pension funds are holding 5 to 10% of assets in cash or cash equivalents, up from 2 to 3% in prior years. They're building liquidity. And historically, building liquidity is what institutional investors do when they expect markets to become volatile or decline. You don't hold cash to maximize returns. You hold cash because you expect better buying opportunities later. The data is clear. Pension funds are de-risking. They're reducing equity exposure at a scale not seen since the 2008 financial crisis. And this shift is accelerating in 2025. So why is this happening? What are pension fund managers seeing that's causing this massive reallocation? There are 5 primary reasons, and all 5 are more severe today than at any point in the last 40 years. Reason 1 is valuation risk. Stock market valuations are at historic extremes. The S&P 500 price-to-earnings ratio is above 25. The only times it's been higher were 1929 and 1990 to 2000. Both preceded market crashes of 50% or more. The Shiller-Cape ratio, which averages earnings over 10 years to smooth out cyclical fluctuations, is above 35. That's in the top 1% of all historical readings. And historically, when the Cape ratio is above 30, subsequent 10-year returns have been poor or negative. Market cap to GDP, sometimes called the Buffett indicator, is at 180%. That means the total value of all publicly traded stocks is 180% of US GDP. The historical average is around 70 to 80%. The only time it was higher was the dot-com bubble peak in 2000, and after that peak, the market fell 50%. Pension fund managers look at these valuations and conclude that stocks are priced for perfection. There's little upside and significant downside. And when you're managing retirement assets for millions of people, you can't take 50% drawdown risk. So they reduce equity exposure. Reason 2 is rising interest rates. From 2008 to 2021, interest rates were near zero. The Federal Reserve held the Fed funds rate at 0 or near 0 for most of that period. The 10-year Treasury yield was below 3% and often below 2%. In that environment, pension funds felt forced to hold equities because bonds offered no return. But that changed in 2022. The Federal Reserve raised rates from 0.25% to 5.5% in 18 months. The 10-year Treasury yield went from below 1% in 2020 to over 4.5% by late 2025. Suddenly, bonds were attractive again. You could earn 4.5% per year with zero credit risk. That's compelling. For a pension fund, this changes the calculation entirely. If you can earn 4.5% in treasuries and 5 to 6% in investment-grade corporate bonds, why take the volatility and downside risk of equities? Especially when equity valuations suggest future returns might only be 4 to 6% anyway. So pension funds have been shifting back into fixed income. They're buying 10 and 20-year treasury bonds, locking in yields above 4%. They're buying corporate bonds yielding 5 to 6%. And they're buying inflation-protected securities, TIPS, to hedge against potential inflation resurgence. Reason 3 is the demographic time bomb. Pension funds, particularly public sector pensions, face a massive demographic challenge. The population is aging, the number of retirees is increasing rapidly, and the ratio of active workers to retirees is collapsing. In 1980, the typical public pension fund had 7 active workers contributing for every 1 retiree receiving benefits. Today, that ratio is closer to 2 to 1, and in some pension systems, it's 1 to 1 or worse. That means pension funds are shifting from accumulation mode to payout mode. When you're in accumulation mode, with more contributions coming in than benefits going out, you can afford to take risks, you can hold equities and ride out volatility. But when you're in payout mode, you can't afford a 50% drawdown. If the market crashes and you're simultaneously paying out billions in benefits, you face a funding crisis. So pension funds facing demographic pressures are de-risking. They're moving into stable income-generating assets that can fund current benefit payments. They're reducing exposure to volatile assets like equities. Reason 4 is underfunding crises. Many pension funds, particularly state and local government pensions, are severely underfunded. According to estimates, U.S. public pensions have a combined unfunded liability of approximately $1.5 to $4 trillion, depending on the assumptions used. That means they've promised more in benefits than they have assets to pay. When a pension fund is underfunded, the managers face a terrible dilemma. Do they take more risk to try to earn higher returns and close the funding gap? Or do they reduce risk to avoid making the underfunding worse? Historically, some underfunded pensions took the first approach. They increased equity allocations, sometimes to 70 or 80%, hoping for high returns. But that strategy backfired in 2008 when equities crashed. Underfunded pensions that had taken more equity risk saw their funding ratios collapse, and many haven't recovered. So now, the approach is shifting. Regulators and pension boards are demanding more conservative allocations. They're telling fund managers to de-risk, even if it means accepting lower expected returns. Because a 30% equity decline on an already underfunded pension would be catastrophic. This is happening across the country. Illinois, Kentucky, New Jersey, Connecticut, states with severely underfunded pensions are reducing equity exposure to protect against downside risk. Reason 5 is regulatory and political pressure. After 2008, regulations governing pension fund investments were tightened. Pension funds face stricter risk management requirements. They have to stress test their portfolios against market crashes. And in many cases, regulators are requiring lower equity allocations. There's also political pressure. When pension funds lose money in a market crash, taxpayers have to make up the difference. Politicians who have to explain to voters why their taxes are going up to bail out pension funds are demanding more conservative investment strategies. So pension funds face mandates from regulators and boards to reduce risk. And the easiest way to reduce risk is to reduce equity exposure. All 5 of these factors, valuation extremes, rising interest rates, demographics, underfunding, and regulatory pressure, are pushing pension funds out of equities. And they're all intensifying in 2025. So what happens when pension funds exit equities on this scale? We have historical precedent. And it's not encouraging for stock prices. The first major example is the 1968-1982 period. In the late 1960s, pension funds began reducing equity allocations after the stock market peaked in 1968. Valuations were high, interest rates were rising, and pension managers became cautious. From 1968 to 1982, the stock market went nowhere. The Dow Jones Industrial Average was at 995 in January 1968. 14 years later, in August 1982, it was at 777. It fell 22% nominally. But adjusted for inflation, which was severe during the 1970s, the real return was negative 40%. Stocks lost 40% of their purchasing power over 14 years. During that period, pension funds steadily reduced equity allocations. By the early 1980s, pension fund equity allocations had fallen to 40% or below. The exodus of institutional capital contributed to the prolonged bear market. Stocks didn't recover until 1982, when interest rates peaked at over 15% and then started falling. The decline in rates made stocks attractive again. Pension funds started buying. And the great bull market of 1982-2000 began. The second example is 2000-2002. After the dot-com bubble burst, pension funds reduced equity allocations sharply. Many had been overweight tech stocks during the bubble. When the Nasdaq crashed by 78% from peak to trough, pension fund losses were enormous. Between 2000 and 2003, pension funds reduced equity allocations from an average of 65% to 55%. That 10 percentage point reduction, applied to the multi-trillion-dollar pension fund industry, meant hundreds of billions of dollars exiting stocks. And the stock market suffered accordingly. The S&P 500 fell 49% from March 2000 to October 2002. It took until 2007 to recover to the previous highs. That's 7 years of zero returns. The third example is 2008-2009. The financial crisis saw pension funds reduce equity allocations from an average of 58% in 2007 to 49% by 2009. Hundreds of billions of dollars were pulled out of equities, exacerbating the crash. The S&P 500 fell 57% from peak to trough, and pension funds that maintained high equity allocations through the crash saw their funding ratios collapse. The lesson reinforced the need for de-risking. Now, stocks did recover after 2009. But that recovery was driven by unprecedented Federal Reserve intervention, quantitative easing, zero interest rates, and trillions of dollars in asset purchases. The Fed essentially forced investors into equities by making all other assets yield nothing. Pension funds increased equity allocations through the 2010s because there was no alternative, but that dynamic has reversed. Interest rates are no longer zero. The Fed is no longer buying assets. And pension funds are no longer forced into equities. They have alternatives, and they're taking them. The pattern is clear. When pension funds exit equities at scale, stock prices suffer, not immediately, not in a single crash, but through prolonged periods of poor returns. Markets grind sideways or drift lower, valuations compress, and it takes years for conditions to improve enough for pension funds to return. We're in the early stages of that pattern now. Pension funds started exiting in 2022. They accelerated the exodus in 2023, 2024, and 2025, and $4.2 trillion has already left equities. But the reallocation isn't complete. Many pension funds are still overweight equities relative to their long-term targets, which means more selling is coming. And here's the critical point. Pension funds don't panic sell. They don't dump everything at once. They sell slowly, methodically, over months and years, which means this $4.2 trillion exodus is creating persistent selling pressure. Every month, billions of dollars in pension fund capital is being reallocated out of stocks and into bonds, alternatives, and cash. That persistent selling pressure suppresses stock prices. It prevents sustained rallies, and it creates an environment where any negative catalyst, a recession, an earnings disappointment, a geopolitical shock, can trigger sharp declines because there are no buyers stepping in. So what does this $4.2 trillion exodus mean for stock markets? Let me walk through the mechanics and the implications. First, it removes the largest source of consistent demand. Pension funds have been the bedrock buyers of equities for decades. Every month, pension funds receive contributions from employers and employees, and every month, they invest those contributions. That created steady, predictable demand for stocks. But when pension funds reduce their equity allocations, that demand disappears. Not only are they not buying new shares with incoming contributions, they're actually selling existing holdings to rebalance portfolios. That flips them from net buyers to net sellers. The scale matters. If pension funds collectively are net sellers of $50 to $70 billion per month, that's $600 to $800 billion per year. The total market capitalization of U.S. stocks is approximately $50 trillion. So pension fund selling represents 1 to 2% of the market per year. That might not sound like much, but it's a massive amount of persistent selling pressure. And it's not just the direct selling, it's the absence of buying. When stocks fall and pension funds aren't stepping in to buy the dip, there's no support. Declines accelerate. Second, it forces other investors to reassess. Pension funds are seen as smart money. They have resources, expertise, and long time horizons. When they exit equities, other institutional investors, endowments, sovereign wealth funds, insurance companies, pay attention. If pension funds are de-risking, maybe we should too. This creates a cascade. Pension funds sell. Endowments see that and reduce equity exposure. Insurance companies follow. And suddenly, all institutional investors are selling simultaneously. Retail investors, who follow institutional trends, start selling too. And you have a self-reinforcing cycle. Third, it reduces liquidity. Pension funds are large, patient buyers. When they step back, market liquidity declines. Bid-ask spreads widen. Price volatility increases, and markets become more fragile. A market with deep, patient institutional buyers can absorb shocks. A market without them can't. We've already seen signs of this in 2023, 2024, and 2025. Intraday volatility has increased. Markets have had more frequent sharp moves, and rallies have been shorter and more fragile. That's consistent with reduced institutional participation. Fourth, it creates valuation compression. When demand for stocks falls, prices fall, and when prices fall, valuation ratios decline. The S&P 500 might be trading at 25 times earnings today, but if pension funds are persistent sellers, that multiple could compress to 20, 18, even 15 times earnings. A compression from 25 to 15 is a 40% decline in stock prices, even if earnings don't change. That's the mechanical impact of reduced demand, and historically, valuation compressions happen slowly. The market doesn't crash in one day. It grinds lower over months and years as institutional capital exits. Fifth, it shifts leadership in markets. Not all stocks are equally affected by pension fund selling. Pension funds tend to own large cap stocks, the Apples, Microsofts, Amazons of the world. When they sell these blue chip names. So we might see a divergence. Large cap stocks, which pension funds are exiting, underperform. Small and mid cap stocks, which pension funds own less of, hold up better. Defensive sectors like utilities and consumer staples, which pension funds might favor for income, outperform. Growth stocks, especially high valuation tech stocks, underperform. This rotation is already visible in market data from 2024 and 2025. Large cap tech stocks, which had led the market for years, have underperformed. Value stocks and dividend-paying stocks have outperformed. That's consistent with institutional selling of growth and reallocation to income. Sixth, it raises the risks of a feedback loop with the real economy. When stock prices fall, wealth effects are negative. Consumers who see their 401k balances decline spend less. Companies whose stock prices fall have less access to capital. They delay expansions and hiring. And if the stock market decline is severe and prolonged, it can push the economy into recession. A recession then hurts corporate earnings. Earnings fall, stock prices fall further, pension funds sell more. And you have a vicious cycle. This is what happened in 2008. The financial crisis caused a stock market crash. The crash caused a recession. The recession caused earnings to collapse. And earnings collapses caused more stock selling. We're not there yet. But the conditions are forming. Pension funds are exiting equities. Stock prices are fragile. Economic growth is slowing. And if a catalyst triggers a sharper decline, the feedback loop could engage. The pension fund equity exit doesn't just affect stock markets. It has broader economic implications because pension funds are tied to retirement security. And when pension funds struggle, millions of retirees and workers face financial uncertainty. First, it exposes the pension funding crisis. Many pension funds, particularly state and local government pensions, are severely underfunded. They've promised more in benefits than they have assets to pay, and the underfunding is getting worse. And when pension funds were earning 8 to 10% annual returns on equity-heavy portfolios, they could keep up with benefit obligations. But if they reduce equity allocations and shift to bonds yielding 4 to 5%, their expected returns fall. And lower returns mean the funding gap widens. According to estimates, U.S. public pension funds use an average assumed rate of return of 7%. That's what they need to earn to keep pension systems solvent. But if they reduce equity allocations from 60% to 40% and hold more bonds, their realistic expected return falls to 5 or 6%. That 1 to 2 percentage point shortfall compounds over time and creates trillions of dollars in additional unfunded liabilities. And who pays for that? Taxpayers. When pension funds can't meet obligations, state and local governments have to increase contributions. That means higher taxes or cuts to other public services. Roads don't get repaired. Schools lose funding. And taxpayers face the bill for pension shortfalls. Second, it threatens retirement security for millions. Approximately 140 million Americans have money in pension funds or 401k plans. Many are counting on those assets to fund retirement. If pension funds reduce equity exposure and earn lower returns, retirement account balances grow more slowly. For a worker in their 20s or 30s, lower returns over 40 years mean they'll retire with significantly less wealth. The difference between 7% annual returns and 5% annual returns is enormous over decades. A portfolio growing at 7% doubles every 10 years. A portfolio growing at 5% doubles every 14 years. Over 40 years. That's the difference between retiring with $2 million versus $1 million. Millions of Americans will have to work longer, save more, or accept lower living standards in retirement. That has societal implications. Older workers delay retirement, which reduces job opportunities for younger workers. Consumer spending falls as retirees have less income, and social safety nets come under pressure. Third, it creates political instability. Pension crises are politically explosive. When retirees don't receive promised benefits, or when taxpayers are hit with massive bills to bail out pensions, political backlash is severe. We've already seen this in states like Illinois, Kentucky, and New Jersey, where pension underfunding has led to fiscal crises. Tax increases have been proposed, benefit cuts have been discussed, and public anger has erupted. Protests, political campaigns, and legal battles have followed. If pension underfunding worsens because of lower investment returns, these conflicts will intensify, and they'll spread to more states and cities. Pension crises could become one of the defining political issues of the late 2020s. Fourth, it forces difficult policy choices. Governments face three options when pension systems are underfunded: increase contributions, raise taxes, cut benefits, break promises to retirees, or inflate the debt away, print money, and devalue currency. None of these options are popular. Raising taxes hurts economic growth and angers voters. Cutting benefits breaks legal promises and triggers lawsuits. And inflating the debt away destroys purchasing power for everyone. But one of those three options will have to be chosen, and the choice will have massive economic consequences. Higher taxes slow growth. Benefit cuts reduce consumer spending. And inflation erodes living standards. All three paths are painful. Fifth, it changes the relationship between workers and employers. As defined benefit pension plans fail or struggle, more companies are shifting to defined contribution plans like 401ks. This transfers investment risk from the employer to the employee. In a defined benefit plan, the employer promises a specific monthly benefit for life. The employer takes the investment risk. If returns are poor, the employer has to contribute more. In a defined contribution plan, the employee contributes a fixed amount, and the retirement benefit depends on investment returns. If returns are poor, the employee retires with less money. This shift is already well underway. Most private sector workers now have 401ks rather than pensions. And as public sector pensions struggle, there's pressure to shift public workers to 401k style plans as well. This changes retirement security for millions. It places the burden of investment decisions and risk on individuals who may not have the expertise or temperament to manage it. And it increases inequality. Sophisticated investors who understand markets and can afford advisors do well. Unsophisticated investors make poor decisions and end up with inadequate retirement savings. All of these dynamics, funding crises, threatened retirement security, political instability, difficult policy choices, and shifting risk to workers, are being driven by the same underlying forces that are pushing pension funds out of equities: demographics, valuation extremes, and the reality that the 40-year bull market that funded pensions is over. So if you're not a pension fund manager, if you're just an individual investor trying to save for retirement, what does this mean for you? How should you think about the $4.2 trillion pension fund equity exit? First, it's a warning signal. Pension funds are sophisticated, well-resourced, and have legal obligations to act prudently. When they're exiting equities at this scale, it's not random. They see risks, and individual investors should pay attention to those risks. The risks pension funds are responding to, extreme valuations, rising interest rates, economic fragility, apply to everyone. If pension funds think stocks are overvalued and bonds are attractive, that's relevant information for individual investors. That doesn't mean you should panic sell everything, but it does mean you should reassess your asset allocation. If you're 100% in stocks, that's probably too aggressive given what institutional investors are doing. Consider reducing equity exposure and increasing allocations to bonds, cash, or alternative assets. Second, it changes the expected return profile for equities. For 40 years, stocks delivered 10 to 12% annual returns. That was the historical experience, and that's what many investors expect going forward. But pension funds are reducing equity allocations because they think future returns will be lower, maybe 6 to 8% instead of 10 to 12%. That's still positive, but it's a significant difference. If you're expecting 12% and you only get 6%, your retirement plans are off by a huge margin. Individual investors need to adjust expectations. If pension funds are right and equity returns are lower going forward, you need to either save more, work longer, or accept lower spending in retirement. Basing your plans on historical returns that may not repeat is dangerous. Third, it suggests bonds and fixed income are back. For more than a decade, bonds were unattractive. Yields were 1, 2, sometimes below 1%. You couldn't live on that. So investors felt forced into stocks. But with 10-year Treasury yields above 4% and investment-grade corporate bonds yielding 5 to 6%, fixed income is viable again. You can build a retirement income stream with bonds. And pension funds are doing exactly that. Individual investors should consider increasing fixed income allocations, not to zero equity. But rebalancing toward bonds makes sense when bond yields are attractive and stock valuations are extreme. Fourth, it argues for patience and liquidity. If pension funds are exiting equities and holding more cash, they're positioning to buy later at better prices. They're not trying to time the market perfectly, but they're building liquidity so they can take advantage of opportunities when stocks are cheaper. Individual investors should do the same. Don't be fully invested at all times. Hold some cash, build a liquidity buffer, and if markets decline 20, 30, 40%, you'll have capital to deploy at better valuations. That's how wealth is built during market cycles. Fifth, it reinforces the need for diversification. Pension funds are diversifying out of equities and into alternatives: private equity, private credit, real estate, infrastructure, commodities. Individual investors should diversify too. You probably can't access the same alternative investments as pension funds, but you can diversify beyond just stocks and bonds. Consider real estate through REITs. Consider commodities through commodity ETFs or gold. Consider Treasury inflation-protected securities, TIPS, to hedge inflation. The goal is to reduce concentration risk in equities. Sixth, it highlights the importance of understanding your time horizon. Pension funds are reducing equity exposure because they're moving from accumulation to payout phase. They need to fund current benefit payments, so they can't afford equity volatility. If you're in a similar phase, if you're retired or close to retirement, you should think similarly. Reduce equity exposure as you approach retirement. Build a more conservative portfolio that can fund living expenses without being forced to sell stocks in a downturn. But if you're young and have decades until retirement, your situation is different. You can ride out volatility, you can handle short-term losses, and you can take advantage of lower prices by continuing to invest through downturns. Your asset allocation should be different from someone who's retired. Seventh, it argues for active monitoring. Pension funds don't set an allocation and forget it. They constantly reassess. They monitor economic conditions, valuations, and market dynamics, and they adjust. Individual investors should do the same. Don't set your 401k allocation in 2010 and never look at it again. Reassess at least annually. If conditions change, if valuations become extreme, if interest rates shift, if economic risks rise, adjust your allocation accordingly. That doesn't mean day trading, but it does mean being aware and willing to make strategic shifts when conditions warrant. We've talked about what pension funds are selling, equities, but what are they buying? Because understanding where the $4.2 trillion is going tells us what sophisticated institutional investors think is attractive. First, they're buying fixed income. The largest increase in pension fund allocations has been to government bonds and investment-grade corporate bonds. With 10-year Treasury yields above 4%, pension funds can lock in predictable income with zero credit risk. For pension funds with liability matching strategies, long-duration bonds are particularly attractive. A 30-year Treasury bond yielding 4.5% provides decades of predictable cash flow. That matches the long-duration liabilities of paying retirees for 20 or 30 years. Investment-grade corporate bonds yielding 5 to 6% offer slightly higher returns with manageable credit risk. Pension funds have been buying bonds from stable companies like Microsoft, Johnson & Johnson, and Walmart, companies unlikely to default. Second, they're buying inflation-protected securities. Treasury inflation-protected securities, TIPS, are government bonds that adjust for inflation. If inflation rises, the principal value of TIPS increases. If inflation falls, the principal decreases. But you're protected against inflation eroding purchasing power. Pension fund liabilities are often inflation adjusted. Retiree benefits increase with cost of living adjustments, so pension funds need assets that keep pace with inflation. TIPS provide that, and pension funds have been increasing TIPS allocations significantly. Third, they're buying private markets assets, private equity, private credit, infrastructure, and real estate. These alternatives offer several advantages. They're less liquid, which means less volatility. They can provide equity-like returns without the daily mark-to-market fluctuations of public equities. And they often include income components. Pension funds have been shifting billions into private credit, lending to middle-market companies that can't access public bond markets. These loans yield 8 to 12%, significantly higher than public bonds. The trade-off is illiquidity and higher credit risk. But for a long-term investor like a pension fund, illiquidity is acceptable. Infrastructure investments, toll roads, airports, utilities, renewable energy projects generate stable, inflation-protected cash flows. Pension funds have been buying infrastructure assets globally. Real estate, particularly income-producing properties like apartment buildings and industrial warehouses, provides rental income and inflation protection. Commercial office buildings are being avoided because of remote work dynamics, but other real estate sectors remain attractive. Fourth, they're buying commodities and real assets. Some pension funds have increased allocations to commodities like gold, oil, and agricultural products. These assets hedge against inflation and provide diversification. Gold is particularly interesting. Pension funds have historically held little to no gold, but some are now allocating 1 to 3% to gold as an inflation and crisis hedge. If more pension funds follow, that could drive significant demand for gold. Fifth, they're holding cash. Many pension funds have increased cash holdings from 2 to 3% to 5 to 10%. This is highly unusual. Pension funds traditionally minimize cash because it earns almost nothing. But today, cash yields 4 to 5% in money market funds. And more importantly, cash provides optionality. By holding cash, pension funds are positioning to buy equities or other assets later at better prices. They're not trying to time the market perfectly, but they recognize that current equity valuations are extreme, and they'd rather wait for better opportunities. The aggregate picture is clear. Pension funds are moving out of risky, overvalued public equities, and they're moving into stable, income-generating assets, inflation-protected securities, private markets, and cash. This is classic de-risking, and it's happening at unprecedented scale. $4.2 trillion. That's how much capital pension funds have shifted out of equities between 2022 and the end of 2025. Not $4 billion. Not $40 billion, $4.2 trillion, the largest institutional equity exit in history. This isn't random. This isn't a temporary tactical shift. This is a structural reallocation driven by 5 powerful forces. Extreme equity valuations, rising interest rates that make bonds attractive again, demographic time bombs as populations age, pension underfunding crises that demand de-risking, and regulatory and political pressure to reduce risk. And the exodus isn't over. Many pension funds are still overweight equities relative to their target allocations, which means more selling is coming. Over the next 12 to 24 months, we could see another $1 to $2 trillion shift out of stocks and into bonds, alternatives, and cash. This creates persistent selling pressure on equities. It removes the largest source of consistent demand, and it raises the risk of prolonged periods of poor stock market returns. Not necessarily a crash, but a grinding sideways market or a slow decline as institutional capital exits. History gives us precedent. In 1968, 1982, pension funds exited equities, and stocks went nowhere for 14 years. In 2000, 2002, pension fund selling contributed to a 50% decline. In 2008, 2009, institutional capital flight exacerbated the crash. We're in the early stages of that pattern now. Pension funds started exiting in 2022. The exodus accelerated through 2023, 2024, and 2025. And if past patterns hold, the full cycle takes years to play out. The implications extend beyond just stock prices. Pension funding crises threaten retirement security for millions. They create political instability and force difficult policy choices. And they shift investment risk from institutions to individuals. For individual investors, the message is clear. Pay attention to what pension funds are doing. They're sophisticated, they're well-resourced, and they're exiting equities at scale. That's a warning signal. You don't have to sell everything, but reassess your asset allocation, reduce equity exposure if you're overweight, increase fixed income now that bonds offer attractive yields, hold some cash for future opportunities, and diversify beyond just stocks and bonds. The 40-year bull market that made pension funds and individual investors wealthy is over. Demographics, valuation extremes, and rising rates have changed the equation, and the institutions that manage $35 trillion in retirement assets are repositioning accordingly. If you want to understand what comes next, subscribe. Turn on notifications. Because as this $4.2 trillion shift continues, it will shape markets, economies, and retirement outcomes for millions. Not in decades, in months and years. And when the full implications become clear, you'll want to understand what happened and how to respond. The pension funds are exiting. The question is whether you'll follow their lead, or whether you'll hold on and hope the old patterns return. History suggests they won't.